So one question that a lot of traders have is what's the best strategy out there? Or sometimes they'll just ask me, what's your favorite strategy? So in this video, I'm going to tell you one of my all-time favorite strategies. I've used this strategy to make over $10,000, and on just one of my 100K funded accounts, I've made $10,171. So in this video, I'm going to show you how the strategy works. I'm going to show you where I got it from. We're going to do some back testing, and we're just going to talk all about this strategy. So let's get right into it. So first, I'm just going to show you proof of that 10K in payouts I was talking about. So right now I'm on Top Tier Trader's website. That's where I have this 100K funded account. I've actually had this funded account for a while now, but as you can see in the corner of the screen, there's my name right there. I'm logged in. I'll even refresh the page for you, right? Refresh the page. My name is still there, right? So when I go to paid payouts, I'll move my face a little bit. So, as we can see, so the first payout, see, like I got on June 12th, $800. About 2 weeks later, got another one for $750. Like 3 weeks later, got another one for $1,000. And I mean, you can see there are some gaps. See, like between November 13th and February 28th, I didn't get a payout. December and January weren't that good of months for me. But yeah, if you add these up, it adds up to over $10,000 in paid payouts. That's after the profit split. I've gotten $10,000 from this account. And I'll just go and show you the dashboard in this account real quick. So I currently have a 62% win rate. I have the ratio of my risk to reward is, let's say, like a 1 to 1.3. Because my average loss is $1,045. My average win is $1,367. So this is the account equity, but let's go to the bottom part. So on this account, I've taken, just make it onto one page. So I've taken 29 trades on this account. Now, one of these trades I actually just had to take to keep the account open because they have like a 30-day inactivity rule, and I was trying to get that first payout. They make you wait 30 days, but every other one of these trades, you see I'm risking $1,000 per trade. And sometimes I'm going for 1-to-1, which is honestly not that common, but it's like 1.5-to-1, 2-to-1. Occasionally, if it's all I can get, I go for a 1-to-1. So pretty much what I'm doing is, you can see I'm only trading on certain days. So this strategy only actually works on days where there's high impact news. But for me to actually explain this strategy, I'm going to go to the charts. So let's hop over there right now. So for me to show you how this strategy works, I've hopped over to FX Replay. FX Replay is my favorite backtesting platform. It allows you to go back all the way to like 2012. So you can rewind and you can just replay price at any point. You can fast forward to the next day. You can trade as if it's live time. And it is just my favorite backtesting platform. If you're interested, check the description. If you use that link along with code TIMB272, you're going to get 15% off. And it's going to be a reoccurring discount. So go check it out. But I'm going to show you this strategy works. So the days you're going to be able to trade this strategy is you're only able to trade it when there's high impact news. So I'm talking red folder news. It works better the more high impact this news is. So I'm talking it works best on days like CPI, PPI. Like CPI is the consumer price index, PPI is the producer price index, non-farm payroll, NFP day. These are some of the best days in my experience this strategy works on. And it also works best, in my experience, on 8:30 news. But it also works good if, let's say, there's news coming out at 10 a.m. It also does work good on that too. Or even if there's like 2 p.m. I haven't really tested it on 2 p.m. news, such as like FOMC. But, so the main idea behind this strategy is once this high impact news comes out, so I've fast forwarded to 8:30 in the morning. This is, what is the date here? Yeah, it's Friday, March 7th. Of 2025. So as you can see, once this candle prints at 8:30, so it's 8:31 right now, the 8:30 candle is printed. So up here, we're going to call this the data high. And then on the bottom, we're going to call this a data low. And also, before I get any further into explaining this strategy, one thing I did forget to say is I actually learned this strategy from a guy named DodgyDD. I'm going to put a link in the description to his video because he's actually the person that taught me this strategy. So if you want a better index explanation, you can just see the source that I learned it from. So I'm going to put the link to his video in the description. But so now that you've marked off the data high and the data low, I'm going to be using inversion fair value gaps to target one of these sides. And it makes it even more high probability when one of them gets taken out. So right now, I fast forwarded 1 minute, right? So the data high has been taken out. So both of these sides are going to be draws and liquidity. So now one of these draws and liquidity has been taken out. What are we going to do next? We're going to be targeting the other side. And it even helps too if, like, let's say I move to like the 1 hour and let's say like I'm bearish here. So we're tapping into like this 1 hour fair value gap, right? We're sweeping these highs just to add extra confluence, right? We're sweeping these relative equal highs. We're tapping into a 1 hour bearish fair value gap, and then we're going to start rejecting off that. And there's even a 1 hour order block up here that we're getting close to. So you could say we're rejecting off all this. Now I'm going to wait for a bullish fair value gap that's going to get invalidated, right? So this is a bearish fair value gap. A lot of people might be entering on that. What I'm going to do though is I want to see a bullish fair value gap get created. So right here, this right here is a bullish fair value gap. So in theory, if we were bullish, this fair value gap should hold. Now, what happens shortly after is this candle right here closes through this bullish fair value gap. So if we were truly bullish, we should be respecting this gap. The bodies of these candles should not be closing through it. So once this happens, I'm going to take a short position. I gave it a little bit of breathing room, just a couple ticks above the high of that, and then I come down here and I target this data low. So this is a 1 to 2.5 risk to reward. So it's a good risk to reward trade. And then in my mind, these data lows and data highs are a very strong draw on liquidity. So that's why I actually go higher risk on these days. Like that top tier funded account, I risk 1%, but that's in relation to the other accounts, that's a high risk trade for me, because I'm usually risking, let's say, 500 on like a futures account. I'm used to trading futures accounts, but so let's just take this trade in FX replay. So I'll market order right there and see how it would have played out. Now it actually did come back to test this order block up here, right? And then it's now testing this new order block right over here. It's coming down. And then there you are. The order got filled. So that's how that trade went. One thing that I forgot to say that's also really important is one of the reasons I like this setup is because in this price leg right here, there's only one singular fair value gap. So I'm on the 1 minute right now, but let's say if there were multiple fair value gaps in like a price leg, I would change time frame to like, let's say like the 2 minute. And let's say if on a 2 minute, there's a singular fair value gap, then I would wait for that 2 minute fair value gap to get inversed. So I want to make sure in that price leg, I find a time frame that's not too high of a time frame, like higher than the 5 minute, but I want to narrow it down so there's only one singular fair value gap in that price leg, and then I'll wait for that fair value gap in that price leg to get inverted. So pretty much what you're doing is you're waiting for that high impact. I'm gonna write this out. Here we go. So step 1, wait for 8:30 high impact news to release. Step 2, wait for one of the sides to get taken first. So step 2 is optional. It's going to make the trade more high probability if you see one of the sides get taken out first. But you don't have to do it. If you see that we're trending toward one of the sides really hard, there have been times that I've taken trades like that. So step 3, wait for a fair value gap to get created in the opposite direction. So let's say if I'm targeting a high, I want a bearish fair value gap to get created. And then once that gets invalidated, we'll be entering. But I mean, I'm getting ahead of myself. So wait for an inversion of the opposite direction fair value gap. And then just market order with stop above swing high. That's the way I do it. There are people I'm sure there are many people that would argue that you should be just putting your stop like for a close above that fair value gap. So that would not be the swing high, that'd be a little closer in, because some people like to have their stop a little tighter. But those are the steps. What's bothering me that I didn't put? It's got to be the same. Right. So I'll just go over it one more time. So step one, we're waiting for 8:30 a.m. high impact news to release. We're going to wait for one of the sides to get taken first. This is optional, but it's going to make your trade more high probability. Step number three, we're going to wait for a fair value gap to get created in the opposite direction. So let's say if I'm targeting data highs, I want to see a bearish fair value gap get created. And then I want to see it, ideally, I want to see it get inversed pretty much immediately. So like it gets created, then we just trade right through it immediately. That shows that there's like we're displacing in that direction, the direction I want it to go. So yeah, once we wait for an inversion of the opposite direction fair value gap, we're gonna market order with the stop. Oh, I said above the swing high, or it could be below the swing low, depending on which way you're going. But this, my thoughts on this strategy overall. So to conclude, I mean, I don't think this should be your main strategy. While I do love this strategy, it's been very profitable for me, I couldn't rely on this strategy. And the main reasons I could not rely on it is because the number one reason is trade frequency. If I'm only trading this strategy when like unemployment claims is coming out, NFP, CPI, PPI, there's only a handful of days during the month that I can actually trade this strategy. And let's say if I go on a losing streak, if there's not many days for me to actually trade, like you saw before, there was a couple period of months where I wasn't getting payouts. That's because the trade frequency is just so low. And the second reason is you should just be diversifying your risk as a trader. Because let's say this strategy has a bad period. If you're only trading from, let's say, like 8:30 to like market open, if you're a trader, there's no reason you shouldn't be trading during your regular trading hours, because the most regular trading hours is like, let's say 9:30 to 11. That's when a lot of traders are trading. But you can use this strategy between like 8:30 and market open, because when I trade this strategy, there's a lot of times that before market open or at market open, my take profit or stop loss is getting hit. So it's almost like I'm getting one extra trade in before the market opens. So me personally, I believe that if you're going to use this strategy, it should be supplemental. It shouldn't be your main thing. It shouldn't be your bread and butter. But those days where you're seeing data highs and data lows, me personally, the way I handle it is I'm just going higher risk. I have a separate account, and I'm just treating it separate than my regular trading I would do from like 9:30 to 11. But we're just going to conclude this video right now. So that right there was one of my favorite trading strategies. I used to hate days such as like NFP, CPI, PPI. I used to not trade the whole day when it was like NFP or CPI. But after I actually started trading this strategy, those days became some of my favorite days to trade. And just looking at the data highs and data lows, it really gives me such an easy draw on liquidity. And one of the things I struggle with is finding draw on liquidity. So if the draw on liquidity becomes easier, they're easier days for me to trade. But I'm really curious to hear what you think of this strategy. So I would love to hear your thoughts down in the comments. And also, don't forget that software I was using, FX Replay, my favorite backtesting software. There's a link down in the description. If you use that link and code TIMB272, you're going to get 15% off, and that's a reoccurring discount. So you should really check that out. I highly recommend FX Replay. I've been using them for a long time. But if you like this video, don't forget, I'd really appreciate it if you give me a like, subscribe, leave a comment down below. I hope this video helped you out. I also hope you have a great day.